Good morning everyone. Today we are going to discuss about introduction of accounting. So before entering into the topic, we have to know what is a necessity for maintenance of accounting. In business, a businessman deals with a number of transactions. For example, he received a number of incomes and he want to pay number of expenses. He have a number of liabilities and asset also. So every day he enter into that number of transactions. So here there is no possibilities for remember all the transactions in mind. For that we have to maintain the accounting. So definition of accounting. According to the American Institute of Certified Public Accountants AICPA defines accounting is the art of recording, classifying and summarizing in a significant manner and in terms of money transactions and events which are of the financial character and interpreting the result thereof. In accounting, we are maintain only the cash and cash related transactions. So first we have to enter into recording. So recording means enter the transactions in journals or subsidiary books. If it is a small scale organization means they enter in journal. If it is a large scale business means they enter the transaction in subsidiary books. Subsidiary books are sales book, purchase written books and sales written books. Because of large scale business are having a large number of transactions. Second, classifying. Classifying means grouping of transaction with the help of ledger. For example, in ledger account, cash ledger account, all the cash transactions are entered. In sales ledger account, all the sales transactions are entered. That is called as classification. Then summarizing. Summarizing is a trial balance, trading account, profit and loss account and balance sheet. With the help of preparing trial balance, we can know the arithmetical accuracy, whether our accounting is right or wrong. Because in a trial balance, debit should be equal to credit. If it is equal, the transactions are right. If it is not equal, it means some mistakes are there. Then trading account. In trading account, we maintained only direct expenses and direct incomes. Debit side, we are entered the direct expenses. In credit side, we entered direct incomes. Example for direct expenses are wages, fuel, carriage inward, etc. Example for direct incomes is sales amount received on sales. That is cash received on sales. With the help of trading account, we can get the gross profit or gross loss. Then profit and loss account. In profit and loss account, we maintained indirect expenses and indirect incomes. Debit side, we entered all the indirect expenses. On credit side, we entered all indirect incomes. Example for indirect expenses are rent paid, salaries paid, etc. Example for indirect incomes are interest received, commission received, etc. With the help of maintenance of profit account, profit and loss account, we can get the net profit and net loss. Then balance sheet. In balance sheet, we entered all the liabilities in debit side and all the assets in credit side. With the help of balance sheet, we can know our financial position, whether our financial position is good or bad. Then objectives of accounting. The first objective is maintenance of accounting records. So in accounting, all the transactions are entered. So when it is necessary, we can easily take that. Without recording, we can't take. So first objective is maintenance of accounting records. All the records are entered. Then second, ascertainment of profit or loss. With the help of proper recording of transaction, we can know accurately our profit and loss. That is the second objective. Third is depiction of financial position. With the help of maintenance of proper accounting, we can know our financial positions, whether our financial position is good or bad. Without preparation of a proper transactions in accounting, we can't get that. Then fourth is providing information. So whenever that information is necessary, we can easily search and take. So that is a fourth objective. Then advantages of accounting: systematic records. All the transactions are recorded in systematically. Then preparation of financial statement. With the help of maintenance of account, we can prepare the financial statement. Third is assessment of progress. Assessment of progress means we can compare our financial positions with past statement. Aid to decision making. With the help of maintenance of account, we can know our financial position, whether it is good or bad. Based on that, we can take the decisions. Evidence in court. The oral transactions are not accepted in court and income tax authorities and government, etc. If it is maintained in a recorded statement, it is accepted by court and income tax authorities also. So these are all the advantages of accounting. Then disadvantages of accounting. The first disadvantages is records only financial aspect. In accounting, we entered only the financial aspect. That is the first disadvantage. Then historic in nature. Only the past transactions are entered. So it is a historic in nature. Third is no cost control method. Only past transactions are entered in accounting. So there is a no chance for control over the cost. Fourth disadvantages is maybe manipulated. So there is a chance for manipulation also. So these are all the disadvantages of accounting. Then we move on branches of accounting. The first is financial accounting. Financial accounting, we maintained trading account, profit and loss account and balance sheet. In financial accounting, only the past transactions are recorded. With the help of trading accounting, we can get our gross profit or gross loss. With the help of profit and loss accounting, we can get the net profit or net loss. With the help of balance sheet, we can get our financial position, liabilities and asset, whether it is good or bad. The second branches of accounting is cost accounting. The cost accounting include the expenses are entered into production of a particular goods or services, etc. With the help of maintenance of cost accounting, there is a chance for reduce the expenses and control over the cost. Then third branches of accounting is management accounting. So management accounting helps to managerial decision making about a particular management accounting helps to managerial decision making for preparing budget, etc. So next we move on accounting terminology. Some accounting terminologies. So first is capital. Capital means it is represent owner's fund invested in business. Capital means owner's fund invested in business. For example, if A and B are started a new business, A invested 5 lakh and also B is invested 5 lakhs. So both are invested 5 lakh plus 5 lakh. So 10 lakh. So the 10 lakh is capital. That is owner's fund. It is also known as owner's equity or net worth. The second is liability. Debts repayable to outsiders by the business are called as a liability. So debt repayable. For example, we purchased raw materials for credit. So within 2 or 3 months we have to repayable to particular salesman. So that is a debit. So it is called as a liability. Debits repayable to outsider by the business are called liabilities. Then assets. Anything of value owned by a business are called as an asset. The values owned by a business is called as a asset. For example, land and buildings, machineries. These are all the example for asset. Then revenue. Revenue is the total amount of income generated by the sale of goods or services related to a company's primary operation. So, amount received by selling goods or services related to our business is called as a revenue. For example, uh, textile industry sells dress materials to their customers. So, in income earned by that is called as a revenue. Expenses. It is any amount spent in order to produce and sell the goods and services which brings in the revenue. So amount spent in order to produce and sell the goods and services. With the intention of earning, we are spend some amount for production or selling and distribution purpose. That is called as a expenses. Then debtor. A person who receives a benefit without giving money or money's worth immediately but liable to pay in future is a debtor. Who receives a benefit without giving money or money's worth. For example, my customer buy goods for credit. So my customer is not paid the cash for immediately, but he will pay after some days or 1 or 2 months. So that person called as a debtor. Creditor. A person who gives a benefit without receiving money or money's worth immediately but liable to claim in future is a creditor. The same example, I gave to my customer goods for credit. Here I am a creditor. I am not receiving any cash or cash related items immediately, but in future I will receive. So here I am a creditor. Then purchase. Buying of goods with the intention of resale is called purchase. Buying of goods with the intention of resale is called purchase. For example, A industry purchased raw materials. What is the intention? He bought for resale. He purchased raw material. After some processing, he converted into finished goods. Then he will sales. So here the intention is resale. So that is called as a purchase. Then sales. Selling of goods in normal course of business is termed as a sales. Goods sold by normal course of business, it is called as sales. For example, as textile industry sells dress materials to their customer, it is called as a sales. Stock. We can simply say stock. Stock means the unsold goods are called as a stock. If it is in opening, that is called as opening stock. If it is in closing, it is a closing stock. Goods. Goods means the term goods includes all merchandise, commodities, etc. Goods means what the particular industry or a company exactly deals on. That is called as a goods. Solvent and insolvent. A person who has assets with realizable value which exceed his liabilities is solvent. The person who has an asset excess of their liability, he is called as a solvent. For example, A have a liabilities of 50,000 and he have a assets of 1 lakh. He is called as a solvent because his assets is over the liabilities. Then insolvent. A person whose liabilities are more than the realizable values of his asset is called as an insolvent. The same example, A has a liability of 1 lakh and also asset is 50,000. So His liabilities is over than asset. So he is called as a insolvent. With this, I completed my session. Thank you.